G'day and welcome to this week's video. This week I wanted to chat about one issue that comes up in my business on a regular basis, and it's the retired men that mostly do this. It's not the ladies, it's the men that are chasing high dividends. So they are looking and assessing what they think the quality of the business is based on whether it has a high yield or not. So the higher the yield, the higher the quality of the business. And I can tell you now that one thing to know to be a great investor, that a high dividend yield has got absolutely nothing to do with the quality of the business. In fact, I see a high dividend yield and therefore a high payout ratio, I'll chat more about that in a sec, as more of a sign that the business is quite mature and it's not reinvesting much of its profits back into the business to grow for the future. So therefore it's paying out the majority of its profits each year as a dividend, and therefore it has a high dividend yield. So for me, I much prefer a business that will pay out a reasonable a modest dividend and keep some of the profit they make each year as what they call retained earnings, and that is a calculation called the payout ratio. So if you have a payout ratio of 50%, so for every $1 of profit that business makes, it will pay out 50 cents as a dividend, and it will retain 50 cents to reinvest back into the business to improve their products and services, to sell more of those things and increase revenue and profitability over time. So dividend yields themselves are a really blunt axe. I would also suggest that people have a look at, whilst it may have a high dividend yield, go and have a look back and see what the dividends have done in the past. Have they been sustainable? And a great example of this, and what I would call not a very high quality business, is Telstra. So 10 years ago, they were paying 30 cents out. They were paying 100% of their profit out as a dividend. They were paying 30 cents per share. Wind the clock forward 10 years to now, and I think it's around 18 cents per share. So, and they're still paying out 100% of their profit. In some years, they paid out more than 100%. So they were using cash reserves or debt to fund their dividends. So please don't get hung up on chasing high dividend yields. I would much prefer to see a lower, more modest dividend yield, reinvestment back into the business to grow it, and also growing dividends over time I see as far more important. In that measure in isolation, dividend yield is a very blunt axe. Thank you for listening. If you've got any suggestions or any questions, anything you'd like us to cover in our videos, please ask a question in the comments below. That'd be great. Thank you for listening.